If you're new to trading, understanding order types is essential. In today's video, I'm going to explain you all the important order types you need to know, from market orders to limit orders, and also what is a stop loss, what is a take profit. So by the end of this video, you have seen some real-world examples and you know how to use order types to your advantage. So let's dive into it. So welcome back to the charts, and now let's have a look at some different order types, because for us traders to actually be exposed to the markets, we obviously have to take a trade, and for that we need to know which order type to use for what specific trade. What are order types and why are they important? So an order type is an instruction given by you as a trader to your broker on how to execute a trade. And the purpose is that different order types allow traders to control their entry and exit points, manage risk, which is very important, and execute their strategies efficiently. So the first order type I want to have a look at is a market order. So a market order allows for immediate execution at current price. The definition of a market order is that a market order is an instruction to buy or sell immediately at the best available current price. So let's have a look at this. And for this, I want to use BTC. Because we don't have too much volatility for now, I want to go down to the lower time frame so we can actually see what's going on down here. And in this example, I'm going to use a simple paper trading account on TradingView. Okay, so for a market order, what you want to do on TradingView is look at this field right here. So currently, or that is what it's automatically set at, is always a limit order, but we want to use a market order. So you click on market. The next thing you can do is select the units you want to trade. So for this example, let's just use 2 units. So this will be 2 contracts of BTC, right? So now we want to predefine a stop loss that will be below this low right here. So I'm going to use 97,440 as my stop loss. 97,440, I can type it in here. It's going to show me the predefined risk of this trade, which will be 437. And I also want to use a take profit. That is going to be 98,000. This is just an example. So we can see the execution of a market order. And what a market order should do is give me the instant order execution at this price. So you will always see the current price at your right vertical value field here. Okay, so I'm going to place an order here and you can see instant execution, right? So that is the benefit of using market orders, because we can get the current traded price with an instant execution. The use case for this is that it's ideal for traders who prioritize getting into or out of a position quickly, especially in fast-moving markets. And this is very important for scalp traders, for example. So I myself identify myself as a scalp/day trader. And for me, when I'm scalp trading, so trading on the very low time frames, I need to ensure a very fast execution of my orders. And for that, I'm always using market orders. Now, when it gets a little bit more complicated, there's things we have to take into consideration as well, and that is the fees. So when we're trading Bitcoin, the fees on market orders are significantly higher as opposed to the fees on futures. So while on futures, I don't really have to care about the fees of market orders too much, I do have to keep that in mind for Bitcoin, and also think about a different order type, which is limit orders. So that's what I'm going to cover next. So for this trade, that was just an example. I'm just going to close this trade because here I just wanted to show you the execution of a market order. So I'm going to close this, and this, by the way, if I close a position, this is also via market. Okay, so here this position is now closed, and let's have a look at the next order type, which is limit orders. So for limit orders, we can control our entry and exit prices. A limit order is an instruction to buy or sell at a specific price or better. So that means I can already identify a level of interest, which, for example, can be the $98,000 zone on Bitcoin, sitting above all these highs, and I can place a limit order that if price reaches this level, it is going to fill a trade. So that means I'm not executing where we are now, and instead wait for a predefined level to be hit and then automatically place a trade. So for this, I don't even have to be in front of my computer. Once the limit order is set, it is going to execute my trade no matter what, unless I cancel the order, obviously. So the order will only execute at the specified price or a more favorable price. It won't execute if the market doesn't reach the limit price. So that means if I place a limit order, which I'm going to do now, so here from market order, I now have to set it to limit order. And what I want to do is look for a short trade, so a sell order around 98,000. So I can type in 98,000. And for this, I only want to place a stop loss. So let's just say, this is just an example, right? So I would not place this trade right here, so it's not an actual trade, just to show the execution. Let's use 98,200 as the stop loss, so that will give me a $400 risk, and I can now set this limit order. So this limit order is only going to be executed if price increases and hits the 98,000. So once that level is hit, it is going to execute the sell limit, and it is automatically placing my market stop loss. So if price just breaks through 98,000 and hits 98,200, my limit sell order here is going to be cancelled and stopped out at 98,200. So this can be particularly helpful if a trader is not actively in front of the PC and wants to place trades at predefined high levels of confluence. So for me personally, I would only preset levels via limit if I have a very strong statistic or a very strong confluence at a specific level, and allow myself to enter a trade without waiting for the reaction. So unlike with market orders, a limit order does not allow you to wait for a reaction at the level, and instead enters the trade whenever your predefined level is hit. The use case is that it's useful for traders who want to ensure they enter or exit a trade at a specific price level. What you want to note is that limit orders may not be filled if the price never reaches the desired level. So that is what I wanted to say here. If price is just dropping to the downside and never reaches that $98,000 zone, you won't get filled on this trade. And that means if you are very confident that price is dropping from here, a market order might be the better choice, because then you are definitely going to be exposed to the markets, while with a limit order you might be left behind. So now there's one more thing I can show you, and that is how to combine both entry types, which is specifically interesting for trading Bitcoin. So here what we want to do is place a market buy. So this is going to be a simple long trade down here. I can set my stop loss just for the sake of this example. But on BTC, what I would normally do on Bybit is to set a take profit via limit order. And that is for the reason that limit orders have a lower fee as opposed to entering on market. So for example, if I want to close this trade at 98,000, I can also set a limit sell at 98,000. So this will then this is going to be a take profit order, but instead of using a market order, this is going to be a limit order. Okay, so this is a little bit of a trick on how to save some fees on Bybit. All right, so you want to market, no financial advice, but you want to market on, or you want to enter a trade on market, and you want to close a trade on limit orders. So that's that example. And now let's also cover a stop loss order. So a stop loss order is protecting against adverse price movements. So that means down here, I am expecting for price to rise, hypothetically speaking. So it's not an actual trade, but just for the sake of example, if I'm taking a long trade, I would obviously expect price to rise. So a stop loss order is going to protect me for a scenario where that is not happening. So if price keeps dropping to the downside, I can predefine a level where I want to be out of the trade and limit my loss, because nothing is limiting price without a stop loss to just keep dropping to the downside, and my loss of a specific trade can be infinitely large, right? So that is why we always place a stop loss. A stop loss order automatically sells a position when the price reaches a predetermined level, limiting potential losses and vice versa. So this is what I'm doing down here. Before I enter a trade, I know where my stop loss is going to be, and I know how much I am going to risk in that specific position. So the order converts to a market order once the stop price is hit, selling the asset at the best price available. So that means a stop order is a market order, ensuring me to be filled once that price is hit. Okay, so once 97,409.5 is hit in this specific example, this is going to convert to a market order and instantly closing my trade. The use case is that obviously this is essential for risk management. Stop loss orders help prevent large losses in volatile markets, and I myself use a stop loss for every single trade I'm taking. In highly volatile markets, the actual price may differ from the stop loss level. This is called slippage, or this can also happen when trading on a very large account. So it always comes down to the liquidity at a specific level to see if we can get filled at that exact price. Now that doesn't matter too much for trading futures, because on futures there's literally zero slippage. But on Bitcoin, that is something we might want to consider as well. So it does make sense to always allow a little bit of room for a stop loss for a scenario that it's not going to be the exact predefined level. And this shouldn't lead to any larger losses, all right? So let's also have a look at take profit orders. And for this, I want to cancel this order right here to then have a look at a limit or a predefined take profit level. So a take profit order automatically closes a position when the price reaches a predetermined profit level. So let's have a look at this. We are now in a trade on BTC. We can reduce the risk a little bit more to keep risk management in mind and the risk to reward, which is going to be its own separate lesson. And here I want to take profits if we make a new local high. So here we can see my take profit is set above this local high at 97,760. So once price reaches that level, it's going to take my position or take the take profit of $405 and close the position. This is going to cancel all orders. So the stop loss order is going to disappear. My long trade here is going to disappear. This order is going to be filled. So my trade is simply closed for $405 profit once that level is hit. The order triggers a market or limit order once the target price is reached, ensuring the trader locks the trade. So, the use case obviously is to secure profits by selling a position at a specific price level. And why is it so crucial to have a predefined take profit? So we need to know where we want to get out of the trade and where to place a stop loss. Because what we can see here, and this is very, very crucial information, which I'm going to cover as mentioned in its own separate lesson. But here we're risking about $200 on this trade. So if the stop loss is hit, I'm going to lose $200 on this trade. But if my take profit is hit, I am going to win $400 on this trade. So that means my potential or expected reward is twice as big as my risk. So from a risk to reward standpoint, I can say this is a trade worth taking because I have double the amount of profits I can make as opposed to the risk I'm taking on this trade. And a take profit and stop loss order helps you to visualize this. So, similar to limit orders, the trade may not be executed if the price doesn't reach the take profit level. So say price is lingering here for a little bit and then we are dropping. I might still be stopped out of this trade unless 97,760 is hit. Let's now have a look at some other order types. And one of them is a stop limit order. This is a combination of a stop and limit orders where the order becomes a limit order once the stop price is triggered. We can also have a look at a trailing stop order. So this is a dynamic stop loss that moves with the price, locking in profits while protecting against losses. This is something we can do on advanced trading software like Orderflow. This is also going to be its own lesson I will teach. So when we look at Orderflow, we can have trailing stop loss, and that means we can preset after what increments of price the stop loss is following the price. So let's say, for example, I am already a nice profit, so $150 profit. I'm happy with that. And now I want to move my stop or trail my stop loss. That means whenever price is moving to the upside, my stop loss is simply going to follow. Here on TradingView, I have to do it manually, but on advanced order flow software, I can do that automatically. So we can see price is now moving to the upside again, and what a trailing stop loss would do is just follow price to the upside. We can, for example, give it $50 difference, and every $50 move to the upside, my trailing stop loss is going to move higher as well. Okay, so this is what a trailing stop loss can do, and that allows you to box in price. So as opposed to having a predefined take profit, a trailing stop loss can just follow price however far it wants to go. That is how I am using trailing stop losses. Sometimes when I do foresee a lot of potential for more upside, I'm just going to let my stop order continue just follow price and continue higher and higher as opposed to closing a trade at a predefined level. So this is now covering the most important order types that I am using on a day-to-day basis. There are obviously many more. Please let me know in the comments below if you want to also learn about good till cancel orders, bracket orders, day orders, because there is a few more. But here I wanted to focus on the most important ones that can actually help you get exposure in the markets as well. And we don't want to overcomplicate it for this beginner series. Choosing the right order type is very crucial because understanding when to use each order type is crucial for optimizing entry, exit, and risk management. And also keep in mind what I talked about with the fees. So once you know these insights that a limit order is cheaper than a market order, you can already have an advantage to other traders who simply are using market orders for each and every entry or exit point. So for risk management, stop loss and trailing stop loss orders help limit potential losses. And also, this is also something you want to note down if you don't have a predefined target for the trade and you foresee a lot of potential. I said you can use a trailing stop loss because that is a method of boxing in price and allowing for just continuation of price to rise to the upside. This can help with profit maximization. If price has more potential to the upside, you might not want to close at a predefined level. One different thing to keep in mind is the execution speed versus price control. So market orders prioritize speed because you will get instant exposure to the markets, while limit orders prioritize control. So you are in control where your order is going to be filled. And to conclude and give a quick summary, different order types give traders the flexibility to control their trades, manage risk, and execute their strategies efficiently. So I hope you could learn something in this video and now understand how to use different order types according to your specific strategy. Stick around because I'll be delivering more beginner videos to you so you can fast track your trading journey and learn alongside us. So see you in the next video.